Greetings, Dave Yeske here, and I want to take about 2 minutes to talk to you about interest rates. And not just interest rates in general, but the effect that rising rates have on the stock market. Now, we all know that we've seen a big spike in inflation in the last 6 to 8 months. And, we could have a whole conversation about where that's coming from, whether it's supply chain disruptions due to COVID or too much money sloshing around in the economy and all of the rest. But the one thing we could be sure of is that interest rates, as a consequence of this inflation, are going to start to rise. Not least because the Federal Reserve is on record saying that they're going to start raising rates, possibly 3 or maybe even 4 times this year in 2022. Partly as a consequence of this spike in inflation. So what can we expect rising rates to do on the stock market? Well, as the heading of this slide shows, one of the things we can expect is to see value stocks performing much better than they have relative to growth stocks. Because low interest rates tend to favor growth stocks where the earnings are expected to be much more loaded into the future. And higher interest rates favor value stocks where most of the earnings are in the near term. So to give you an example, imagine that this is the annual earnings for 2 different stocks projected out over the next 30 years. And you can see that one of them has higher earnings in the moment, but the earnings are growing at a much slower rate. So you might say this is representative of a much more mature company or a company operating in a much more mature industry. The second example, it starts out with much lower earnings in the present, but they grow at a faster rate and they eventually overcome the earnings of the value stock. And you can see that the cumulative earnings for this, what I'm calling a growth stock, over that 30 years are $570, while the cumulative earnings to the value stock is $518. But of course, you wouldn't pay that for either of them because a dollar earned in the future is worth less today. If someone offered to give you $1 a year from now, how much would you pay to have that money today? Well, you wouldn't have to pay $1. You'd pay maybe 99 cents in an environment where interest rates are 1%. Because that 99 cents, if you could invest it at 1%, it would grow to be about $1. Alternatively, if rates were higher, let's say rates were more like 10%, you'd be willing to pay 90 cents today to get $1 a year from now, because you can invest 90 cents at 10% and it'll grow to be about $1. So $1 received in the future is worth less than $1 today. And the more distant the future, the smaller the amount, the equivalent in today's dollars. So let's take these 2 companies and imagine a world which we've seen over the last 10 or 15 years where the prevailing rate of interest is 2%. The 10-year Treasury has been yielding less than 2% for most of the last 10 or 12 years. Well, in such an environment, the opportunity cost of future earnings is much smaller, and that favors the growth stock that has most of its earnings pushed out into the future. You can see that the present value of that stream of earnings from that growth stock is $380 versus $370 for the value stock. Now, alternatively, imagine an environment, one that we seem to be moving into, where rates are rising. Let's imagine an environment where the prevailing rate is 6%. Well, those same 2 companies, that same stream of earnings that we've projected into the future, would be worth less in the present as a consequence of the higher rate of interest that's prevailing. But it impacts the growth stock much more, because how distant those earnings are helps determine how small the present value is. And since those earnings for the growth stock are much more distant, at the higher, what's known as a discount rate, at the higher rate of interest, the value stock is suddenly worth more. Its earnings are worth $209 today versus $184 for the growth stock. So this is just an example that not all stocks and not all segments of the market are affected equally by a change in interest rates. And as we move into this higher interest rate environment, we're going to find that value stocks will tend to do better than growth stocks. Unlike what we've seen in recent years, especially back 2017, 18, 19, where the prevailing low rate of interest was really favoring growth stocks. So that's your economic lesson for today.